and just get all of the nitty gritty, because for such a time as this in the market, we're in the summertime, kind of an unknown seasonality happening right now. So we want to hit on this. So I asked expert here. We've got with us Ryan King, all the way from Canada, and he's going to be sharing it. And let me just tell you a little bit about him too, because he has been around for a good while. He's got 15 years of experience in this whole resource sector. Previously on New Market Gold team, as the company completed a $2 billion transformational merger with Kirkland Lake Gold. And before that, he was involved with starting Terrain Metals, which owned the Mount Milligan copper gold project in British Columbia, and he has assisted with the acquisition of the Terrain Metals by Thompson Creek for $800 million. So we're talking some big dollars, and talking about somebody who has a lot of information to share with us. So we can't wait to hear from Ryan here shortly. He's also been sitting on the board for Nucor Gold, as well as Edgewater Exploration Limited. So let's get started, guys. I'm going to kind of ask you a couple questions. Roger, I'm going to start with you. Then Ryan, I'm going to ask you a question. Then Tom, I'll ask you a question. And then we'll kind of start to get into a little bit of meat and potatoes, if that works for you. So with that introduction and getting started, Roger, with everything going on in the headlines, we've got, everything seems the same. We've got the Fed raising rates, we've got the concerns about inflation, everything kind of same old, we got earnings coming out. When you think about all those things and you kind of put together a lens, how do you see gold through all of this?
Well, first of all, Celeste, it's wonderful being here, and happy Friday to you. And hey, Tom, how are you? Long time no talk. And
I was telling about your Valley Smoke.
Yep, we were talking about you, Roger. Your ears
pleasure,
might have been spoken.
pleasure to meet you, Ryan. Meet you. So I think ultimately right now we're going to be in an inflationary market for a while, and when we're in an inflationary market, typically and historically and seasonally, gold does better than most assets. So we're moving around the 1900 level, and I think we're going to see more upside. I think there's going to be more demand. I think things are going to get a little worse before they get better for the economy, and I think that's going to bode well for the gold market. Now, with that said, with that said, now the U.S. dollar has a lot to do with it too, and the U.S. dollar has been really erratic, a lot more erratic than it usually is. So you have to take that into consideration. That's kind of like the pink elephant in the room and the unknown, in my opinion. But generally speaking, I'm expecting more upside for the gold market in the medium term. Not sure about short term, but medium term, I think we're going to be moving higher. I would put my money on the upside instead of the downside.
Yeah, excellent. Good. Yeah, that whole dollar thing. And I know y'all were talking about that last week. Jeff Smith was talking about that dollar at a certain support level. And of course, it just flew through that this week. So I want to hear more perspective. So Ryan, tell us, I want to hear a little bit more from your perspective about the seasonality of gold. What do you think?
Sure. Yeah. Again, Roger, Celeste, everybody, thanks for having us on. And I just wanted to make a quick comment on what Roger said there, which I think is really quite critical in this whole thing. Is historically, we have seen an inverse relationship between the dollar and gold, right? And even in the last couple of days here, you're seeing the Dixie break down pretty significantly, which, I think, again, that's going to, in the short term and even long term, probably be quite buoyant for gold. Because if you step back right now and we look at the macro picture, what's happening is a de-dollarization globally in a pretty significant way. So I think that we're, potentially maybe even seeing the early signs of the cracking of the dollar. Who knows? We'll see. But there's some big events happening here in the near term with the BRICS countries, i.e., this recent talk about them backing their currency by gold. Right, that's going to be an interesting turn of events. I think potentially even a historical turn of events here for the dollar and for the future of what maybe even gold looks like and how it's reviewed. So, but yeah, to your question, Celeste, seasonality on gold is a pretty big one too, and I think we're heading into what is generally a positive environment for gold as we look towards sort of different types of seasonalities, whether it's investment, as Roger pointed out, uncertain times, inflationary pressures, obviously a good environment for gold, but traditionally sort of October, November, December is also a positive time because of jewelry demand, weddings, different things like this. So I think in general, you take a step back and there is increased demand for gold, particularly with the central banks. We've seen the largest amount of central bank buying we've ever seen in history.
Interesting.
Right. So there's a lot of macro and seasonality perspectives coming into play here, which I think sets up nicely for gold.
Excellent. Maybe you can share a little bit more on all of these topics here just a little bit later. Can't wait to hear. So Tom, as I was mentioning, you've been involved in the gold market for a long time, traded all sorts of gold instruments. What's your view on gold in light of everything right now?
All right, I'm going to look a little bit long. I know this is unusual for everybody to hear me say this, but I think over the next 10 years, you're going to see gold about minimum 2,800. And so that's what I think. As far as the short term, I agree with Roger and Ryan. I think between now and November, gold should be hot. And I traded it. The reason I say that, I traded the I call it the off months, February through about April, and then I laid off because I mean, just every week it's just pop, pop, pop. We went like 20 trades, 21 trades in a row, and I said I'm gonna watch it for a while. I've been watching it, and I'm getting back involved. But I've always been a silver trader using gold. And I got a slide I want to show people today, and they ought to write the symbol down, AGQ. I'm going to show people next week in a flash meeting. I hadn't figured out when I'm going to do it, but I'm going to say we're going to take AGQ and let you get scholarships for Rogers, for everybody, because I'm going to live trade AGQ next week. So anything they buy, be there next week in my flash meeting, and I'll show you how to make AGQ. Because when you see what I'm going to show you with AGQ on the silver side, you go, whoa, I got to have some of this. Okay. So anyway, that's what I think. I'm pretty bullish.
Excellent. Yeah, good. Thanks for that. And another thing I was thinking of when we were just talking here, the other thing, when I was talking to Ryan on the phone the other day, I was talking about what insiders are doing with these gold companies. And that's something else I want you all to hear about, what's happening, because there are definitely some things percolating. It's always great to get a different perspective. I noticed Ryan called our dollar Dixie. Did you guys pick up on that?
I thought that was very interesting.
I did.
I haven't heard that in a while. I'm going
to start using it though. I like it. It was funny. But anyway,
I want to use it too. What do you say?
Dixie.
Dixie, DXY, Dixie.
$1 the Dixie.
I'm sorry. Say it one more time.
Dixie, DIXIE.
Yeah, I'm from Dixie. Is he talking bad about me?
No. It's all
well, I don't
good.
know. Let's see what the future has to hold for the Dixie.
Okay.
We might be coming up there, Ryan, to Canada. We'll see.
Let's see.
Well, Tom, why don't you take over and share with us some of those things you were talking about earlier in the show before we got started? Show us kind of what's
Sure.
going on.
Can we bring my slides up? You got those?
Adam, you got them?
While we're doing this, Ryan, what part of Canada are you from?
I'm from the West Coast. I'm from British Columbia.
Gotcha.
How far is that from Vancouver, Ryan?
Vancouver, Washington, or Vancouver, BC? I'm living right in Vancouver, downtown. Here we are.
Oh, you're in Vancouver?
Yeah.
I got some stories from that. I used to do seminars up there. I love Vancouver.
Well, I tell you, this time of year is the time to be in Vancouver because you get the mountains, the ocean, and everything. You get some good weather finally because we're up in the rainforest here. It's just pounding rain, but otherwise, I wouldn't be here weather-wise any other time of the year but now.
Wow. All right, so let me get started because this is pretty interesting. And there's always risk in anything you do, and I always try to hammer that because you get carried away. You start believing your own hype sometimes when you're trading. You're trading. You got that thrill of victory, but you always remember there's an agony of defeat. And I always like to tell people, tone it down when you get too good, and ask yourself how you can be better. And so there is risk involved in trading. Everybody's got it. And I just tell you, it's just sort of a interesting time when you think that. Let's see if we can do that real quick. There you go. Brought it back for you. I just learned something. I didn't know that. Okay.
Hey.
But anyway, we have an indicator we created this year. It's on the Thinkorswim platform, but there's a concept in trading. Nobody really talks about it, it's called, Roger knows all about this, being with his background. Ryan, you probably do too, but where you try to know where to fish, and a lot of people call it pairs trading. Okay. And all of us, I've seen Celeste do it, and I've done it too. And I think, I don't know if Roger's done it, I haven't seen it, but the equal weighted S&P is trailing those 8 big boys in the general market. And you know, you focus on those 8 big boys, and you can see that all that gain between the difference. And so a good trade is being long RSP and being short the SPY as a pair trade. It's a longer term trade, but I have that trade on, and it's sort of interesting because I think they're going to come together at some point over time. And but it's a good trade. I've never done it with options. I just did it with stock. But the MTI gives you that as a benefit because it keeps up with it on a daily basis, where to go and when to go. Now, that's what it looks like. And then, you know, I was talking about, it's up there in the left-hand corner. It's got the percentages for anything you're looking at. But you can see, if you look at, you know, if you look at that right there, that's a SPY. It's very bullish looking at the chart, but it's up 17%. That's why you're looking up there at the market and you go, hey, we made these new highs. But how would you like to know that, you know, going back to what I was saying earlier about, you know, let's just pick a number here, say 434 on the SPY. You know, I don't know. I always call it getting the Wall Street Journal early. It's at 450, and that's what in about 2 weeks time period. Those blue tags are the Monday's high, Monday's low. And I credit Graham for giving me that through the study because it really works, and it's pretty interesting. So it does it for any market you want to do and makes it good, knowing where to fish. And if you look at the QQQ, now here's a classic case. You got the QQQs up 42%, Apple's up 46 on the year. But notice Apple, and I keep worried about this because Apple's down with this tremendous rally this month. Apple's down even after today, 1.66%, where the general market is sort of holding up there at 3.23 for the month. And what I interpret from that is Apple's either got to get with it, or if you see Apple increase this to the downside, there's going to be a good play there in Apple being short. And that's what it looks like if you look at the QQQ. It's just breakaway blue sky, and then of course you know, it's got all the key information you need. Now, gold and silver. This is a topic that's near and dear to my heart. Gold's been the play this year, up 7% year to date, but I love trading silver, and I've been out of silver now for about a year. Look at what silver's done in the month, 9.24%. I'm long AGQ today, the actual stock. I bought it in the pre-market, getting a head start on next week. But I'm going to tell you, silver is breaking out, and there's going to be a catch-up move. I'll just tell you something. When gold and silver track each other and it's hot to go, silver's going to be leading gold because silver gives you a better return for the dollars than gold does. Gold's more stable. Silver's like a wild monkey, okay? But when it's dancing, it's a fun market to be in. So if you see this yearly get above gold, that's when I'm going to lay down the red tape, or not the red tape, but lay it down because it's going to be really big. Now, AGQ, I put this up here, and I was said next week I'm going to show people how to use the MTI. I'm going to do a flash meeting, and I'm going to show them how to make some bones off AGQ because it's ready to really pay people a lot of money if they know what they're looking for. And so I've got to just have a special session for trading silver next week at some point. I've got to get with Jonathan. He'll tell me when. So that's pretty cool stuff right there. And see how the picture sort of keeps you on the right side of the market? Kept you out here while it was going down. You wasn't taking all the risks, having your face peeled, and all of a sudden it makes it above those lines and off we go. And nice. It's just pretty cool, I think. And here's, how does all this tie into our success? Well, it ties in because we look at a lot of different areas of the market, and having the tools that we have really help. But this was a trade, the 80-20 and the QQQ, 23%. So if you got $1,000 invested, how much money you got now? $1,233, right? $1,000 invested. That was on a new thing I created called the buzz fly. I'll be talking more about that because I don't like butterflies. So I had to alter the traditional way and have my own little special buzz fly. And then the weekend profits, we nailed 15% on the QQQ. This week instead of the SPX, 15.71. So if you got $1,000 invested, how much do you have? And so that's a heck of a trade. Got in yesterday, out this morning, and $1,000, adds up. And there's less risk, the more days you have to expiration. I usually target Mondays, but this was a trade we did. Now I don't know. I want to put this disclaimer out there. Jeffrey Turnmeyer is really an expert when it comes to Bitcoin, crypto, and all that stuff. But unlike so many people, they're just numbers to me. And Mara is a stock that I have just traded in this Bitcoin phase. And I was thinking about buying, some more Ethereum or doing something like that. He told me to do that, and I'm up tremendously. But I thought to myself, I'm going to trade Mara. So I traded Mara up 11.94 or 11.49. And then the Power Play, this is the program that Graham wrote years ago, and the one we're up 60% lifetime, but 37% on the money we invested this week, in on Tuesday, out no later than Friday. Had 3 plays there. MRO, that was an oil play early in the week as oil was breaking up and told me it's time to get oil. Now, oil's in the correction today. My intention was to put on some oil trades today for next week, but it's correcting, and I know it's correcting because look at MTI. It tells me, hold on, Tommy boy, wait a little bit to next Tuesday. I don't like the pain and suffering of having a losing trade. I just don't like it, okay? And then Clorox was a trade that Jeff gave me, up 21% on that. He found it on MTI, matched it up on a roadmap. We got in 21%. But the market timing indicator, if you're a trader, long-term, short-term, we created something here that is something really special, and you find out more about it. We give a VIP program there. Copy that website down, find out more about it, dtitrader.com/MTI VIP. And, so we're sort of taking that lap around. It's one of those things when things get so good, you want to be happy. And, but I'm really excited about next week, July. Now I got to tell you, coming in July, I thought we were going to have a turn to the south side. And I said this morning. I said, the difference in me and most traders that I see is people get an opinion and they'll write it down like the Titanic. With me, I have an opinion just like they do, but I trade what I see. So if this sucker wants to keep going up, I'll be with it. If it wants to go down, I don't care. I don't have a market bias once I put real money on the line. I just do what the numbers tell me to do. Trade what you see. But this is a timely webinar for everybody, having Ryan here because I'm very interested in what he's got to say, because I know that I'll be taking notes as a student, as I always am, and hopefully, I'll get some things I don't think about because, I like I said, I love that Vancouver. It's pretty great city.
Yeah, and thanks, Tom, for sharing all those things. And that was really cool to see that MTI indicator. Love it. And Adam typed that into the chat so people can go learn more about that as well. And so, hey, Ryan, I do have a quick question for you before we head over to Roger as well. But, because Tom was talking about, he's talking about silver, talking about gold. And one thing that we haven't talked about too much, but I'd like for you to answer is, because you're working there with Caliber Mining. You're on the board with Nucor Gold, also the Edgewater Exploration. What do you see going on inside of the gold companies, the mining that you think is important for us to know?
Well, I guess one of the first indicators that I'm looking at right now is that nobody wants to invest in these stocks. Really, there's no financings happening. So that's actually kind of an indication to me that, maybe we've kind of come to a bottom. Maybe there's an interesting, angle here to enter the space. if you're kind of looking at things from a different perspective, because a lot of good things are happening, but the gold price is up at almost all-time highs. And there's a lot of leading indicators or macro indicators that tell us that, very likely, at least the medium to long term, we're going to see higher gold prices. And one of the things, yes, we have felt inflation in our business, so we do have higher costs, but the margins are some of the best margins we've ever seen, kind of almost in history. Incredible margins, so incredible operating cash flow and free cash flow. So one of the reasons that, we see generalists come and go in our space. Oftentimes we have, your natural resource funds that are in there, and then retail. So we don't often get generalist investors into the space. But as this continues, I think we're going to start to see a very broad, large increase in ownership into these gold equities producers, particularly. And what happens is generally, folks will look at the ETFs, then they'll start going down to the royalty companies and the senior gold producers, and then work their way down the longer it goes on. Like we've been at 1900 in this kind of 1900, 2000 range for quite a while now. And yet the equities are trading at such a discount relative to the commodity price. So, a lot of junior explorers or micro caps are not getting any of the capital they need to find new deposits. And so I think that presents an opportunity. And then the valuation of the producers and the royalty companies are at some of the lowest they've been in history relative to the gold price. So I think that's just presenting an incredible opportunity for investors. And like you brought up the other couple of minutes ago, is what are insiders doing? Like from ourselves, we've been buying our stock. Like if you look back a couple of months when we're not in blackout, we've been buying our own equities, right? So I think that's kind of an indicator as well, is that like we think there's an incredible opportunity here. Like I bought a lot of our stock in November, December, January of this past year. I kept buying it every couple of days. I was buying more of it. Fortunately, now year to date, we're up about 60+%. So it's a nice place to be. But I'm not a trader. This is a business. I'm an owner in the business, right? I'm here through it, thick and thin. And I'll continue to average up and average down, because I think this is a tremendous opportunity in the space that's long term, medium to long term, is going higher.
Yeah, and speak to a little bit. I want to get that ticker typed in there as well, from your company that people can go look at too. It's CXBMF. I just typed it in there. Make sure I got that right. But yeah, and before I jump over to you, Roger, too, Ryan, I want to know, because you're heavily regulated as to like the timing as to when you can actually buy your own stock as well. And do you have some things going on right now that's keeping you from being able to buy now? Fill us in a little bit on that.
Well, as an insider in the business, directors, insiders, and large owners of the business, we're very heavily regulated. I mean, you don't want to do any insider trading, of course. Not only regulations imposed to us by the TSX and other exchanges, but also our corporate governance, right? So we have very specific corporate governance that doesn't allow us to buy at certain times. For example, anytime we have production, end of quarter production results and financial results, there's no buying. Anytime we have what we would perceive as significant news, i.e., for a gold company, discovering new material that can have a very positive impact on your net asset value of the business, that's going to be a time to black yourself out. So yeah, there's many times throughout the year. I mean, you look at our news flow over the last 12 months, we're putting out news every 2 to 3 weeks. So that's pretty key for an investor to see regular news and activity for the company they're investing in. And so we have to be very cautious about when we buy.
Excellent. Well, it's good to know. Good to know. Thanks for sharing that. I want to get into some more details here in just a few minutes, Ryan, that you can share with us. So, hey, Roger, want to hear from you. Everybody's raving about what you're doing over in your VIP room, getting just a wealth of knowledge, literally. And so share some of the things that you're seeing, maybe catch us up on some thoughts that you have on today's program so far, and then, catch us up on small caps and earnings, all that sort of thing. Fill us in.
Absolutely. Well, the first thing, and again, I hate to say I told you so, but one of the things that was really worrying me about this earnings season was the fact that we were going to see stocks do better than expected, and the price already be reflected because of the run-ups we've been having in the market. So to give you a good example, yesterday Delta reported earnings, and here's a chart. The numbers were better than expected. What did the stock end up doing? Nothing.
Yeah.
Today, the bank stocks reported earnings. JP Morgan reported earnings. The stock rallied in the morning. It rallied like a bat out of hell. It ran up, went to 153. It's at 148. How about
The
Wells
30-minute
Fargo?
chart, right?
Yeah, this is a short term. I'm just showing you what it did
Yeah.
today, how it opened up and how it just started coming right back down. And right here, Wells Fargo, same thing. The stock rallied up and started coming down. So this is a classic case of the price is already the price is already reflecting the upside in the earnings that are coming out. It's kind of like buy the rumor, sell the fact kind of a thing. So all in all, this is not something. What I'm trying to, I guess what I'm really trying to say is this: the numbers are going to have to be so much better on the majority of these stocks because we've had such a run up in stocks over the last 2 quarters. So it's going to be shocking to see these numbers come to fruition because so far, I mean, we've only seen a handful of companies, but those numbers have been pretty good. And these stocks have not done anything remotely to being, to moving higher. If that's going to be the tone of this earnings season, get your helmet out because this market's going to turn bearish very, very fast. Now, to give you guys a summary, we're expecting, and I would write this down because this is a moving target. And this is going to change. This is going to change as we continue. If this number gets weaker, expect the market to go down. If this number gets higher, expect the market to go up. I guess unless that's already priced in, but I don't know. I don't think that's the case. So we're expecting the market to decline 9.8% from a year ago on flat revenue. That would follow last quarter where we saw a 3.4% decline, and then the last quarter of 2022 where we saw 5.4. So this is the biggest one. In other words, we're expecting the 3 consecutive quarters of S&P 500 declining earnings. The expectation is currently of another earnings decline in the third quarter of about 1.9%, after which this ends, which is why I believe the stock market's going to be choppy, bearish, not having any fun till the end of next quarter because earnings are not going to get better till then. So again, it's just one of those situations where things are not looking great. Now, with that said, I don't want to be the grim reaper here. With that said, earnings estimates in the aggregate have come down only a touch since the start of April. That's a positive because remember what happened last couple of quarters? They just kept coming down. But several sectors are starting to see positive revisions. That's a really, really good sign. Construction, industrial, auto, that's a good one. Technology, medical, and retail. I'm going to repeat them for you guys so you can write them down. Construction, industrial, auto, tech, medical, and retail. Those are seeing better than expected. Now, the financial sector is looking to show a 10% earnings growth in this quarter on 7% higher revenue. Now, with banks, the commercial focus is on commercial and consumer banks. Investment banks and trading businesses are not supposed to do well. So watch out, Goldman Sachs, Morgan Stanley, Schwab. Those are not expected to do nearly as well as the banks. Now, looking at the calendar year as a whole, total earnings are expected to decline about 3.9% on flat revenue, excluding the financial sector, which is kind of the only one really giving us a nice buffer, allegedly, at this point in time. Earnings would be down only 6.5%. 6.5% down if you take away the financials. So unlike energies, which have kept us on the safe ground the last couple of quarters.
Just typed it in, Dennis. Keep going.
So unlike energies, which really kept us on the positive side last couple of years, that's not the case anymore. Now we're looking to financials to rescue us and save the day. So that's the first thing I wanted to talk about. Now, a lot of, and T-Buzz mentioned something interesting. He mentioned him buying the equal weighted index and selling the standard index. The theory behind that is that the smaller stocks or the broad market is going to catch up to those 8 stocks or 7 crazy stocks that have been really rallying us up. So, for example, if you look at the QQQ, equal weighted QQQ, you will see that it's struggling here. This is the equal weighted QQQ. But if you look at the regular QQQ, non-equal weighted QQQ, you will see that it's still breaking out. So I think eventually what's going to happen is the 7 or 8 stocks that are rallying are going to give up the ghost, and the equal weighted QQQE is going to remain firm because, and I'll explain to you why. I think it's going to happen because smaller stocks are starting to move a little bit higher. Now, don't get too excited, and I'll show you why.
Hey, Roger, what was that equal weighted symbol for
How did I know you were going to ask me that a minute ago?
It got
I'll
my
type it in
attention
too.
because I thought of a trade.
QQQE. QQQE. That's 3 Q's and an E compared to the regular QQQ.
You
So
knew I was going to ask you the question.
I knew you were going to ask me that question. And then if you look at I'm going back and forth. If you go to the Russell, sorry, I was at the small caps. So if you look at the Russell 2000, you will see that it looked for a minute. Look at this. It looked really good, right? I mean, look at the last 3 months. But if you look a little further, you will see that it has a lot of hurdles to overcome. And I wouldn't call a rally till we get above 200. But if we do get above 200, and I expect this to happen when large caps are not, I'm going to say that again, I'm expecting this to happen when large caps are not breaking out, because for the last 30 bear markets, the small caps have led us out of a bear market, and I expect this one to. Degenerates always buy stocks first. In a speculative, degenerate stocks always go up first. They're the first to rise in a bull market. But here's the other reason why. If you look at ARK, which is like the king, I mean, they should call this the degenerate ETF, because you'll see that it's nowhere near breaking out, and I wouldn't get too happy till we're at the 70 level. So I said this about, I drew this for you guys back almost over a year ago, and I said this is the bottom of the small caps, and it's been the bottom of the small caps. But in order for us to see a real bull market, we need to see the small caps or have a real breakout above the 872, 73 level. We're nowhere there. We're nowhere near there yet. So we can easily come down. So don't get too excited, because I don't think we're there yet. But I do believe that the large caps, the trade that T-Buzz is putting on, where he's buying the broad market and selling the large 8 stocks, I think that's a very, very good trade. I know you're doing that on the S&P 500 T-Buzz, but you can also do that on the QQQ with the QQQE versus the QQQ.
Now, what you mean to say, Roger, have you done it yet?
Have you done it yet?
Yeah.
Now, a few other things that I'm just to kind of give you some perspective here. Energy market. A lot of folks are talking about the energy market. Now, I do believe the energy market in the mid to long term could potentially go higher. I do. But we're not there right now, and I'll show you why. We're falling, and I did say this over the last 2 days, and I've taken on some short positions in energies that are profitable right now, but including this index itself, we're short XLE right now. But I think we're going to come down to this channel, and I think this channel is going to remain firm. I don't think it's going to drop below this channel. I don't think Warren Buffett would be buying so much energy right now if it wasn't valued properly. But technically, I think we were a little bit overbought, and to prove that to you, we will look at momentum levels on the XLE. We go through this in my VIP room all the time. If you look at the 50-day moving average, you will see that we've been at this current level in the last 10 years. You can just count this. How many times? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, and we're there now. That's over the last 10 years. So we go here about once every year, every 2 years, and we're there right now. In order for us to, and not only the 50-day, you will also see that the 20-day, I use these for swing trading. They're pretty helpful to kind of get a compass of where we're at right now. So if you look at this right now, you'll see that similar type of pattern. We've already hooked lower here, and we don't really, after coming up here, we typically come down. I wouldn't be a buyer right now at these levels. I would wait for this to cool off a little bit. Now, remember, it won't take much. I mean, this is just the number of stocks in the XLE. So it's 40 stocks being above the 20-day line. Just wait for half of them to cool off and then go long if that's what you want to do. Or simply do what I'm going to do, and I'll show you right now what I'll do, is I would just wait for us to go to the bottom of this channel here. And I would be buying the XLE right around here. Nice and simply, I'd like to hold it a little longer before exiting it. So that's one of the major sectors that I'm looking at, and also technology. A lot of folks are asking me about technology. I've been dead wrong. I thought we would have stopped going up about 3 weeks ago. We're still moving up. But I will tell you this, that if you look at a 1-month chart on my stock fetcher, if you start looking at the 11 sectors, and if you look at them on a 1-month basis, you will see the technology on a 1-month basis is starting to come back up as it is on a cumulative basis. So the fact that both the 1-month and the 3-month are holding these up, I would say for now, I would be cautiously optimistic that they'll stay here for at least another couple of weeks, or till technology earnings come out, which isn't for another, 2 weeks, 3 weeks from now, a couple of weeks from now. And then we're going to have a problem, because if you look at stocks like NVIDIA, for example, and I mean, this is an amazing company, but if you look at this company, you'll see that over the last, I mean, look at this from last quarter, let's see, this is in the last 7 to 8 months, the company went up from $100 to $500. There's just so much it can move in a limited time. And I think we're going to peak out around here. The RSI is very overbought, and I think we're going to come back down. And I eventually think we're going to fill this gap. I just don't think there's just that much more upside. Not because they're bad companies, because the upside has been beaten in so much in these stocks. Now, before I let you go, let's review seasonality for next week. We take all of the 11 major indices and we look at seasonality between next Monday and next Friday to see how statistically these 11 sectors do next week. And as you could see here, it's not all that great. I mean, XLU is probably a good time to start buying it middle of next week, comes up at the end. But for the most part, and this is the Dow QQQ, and the gray one is the S&P 500, and they're all kind of doing the same thing. There's just not a lot there. I mean, real estate's looking okay next week. Let's see how financials are looking. Financials are starting off next week kind of poorly, which kind of makes sense in light of what we're seeing right now, but are ending next week well. That makes sense in light of the trout we're seeing right now. It looks like next week is ending okay, but not really starting okay. As you could see that there's a nice big middle dip. But even so, if you look at these numbers, there's no major gains next week. And when Matt and I looked at our seasonality graph, it looked like there was just nothing really major to talk about here. I'll make it a little bigger, but you could see it's just other than real estate and energies, energies don't really look all that great till midweek. Nothing is really looking that exciting. Technology looks kind of choppy. Industrial stocks look like they have a pretty good Monday, but the rest of the week is bad. So I'm not seeing anything that's getting me too excited about anything at this time, Celeste. All right, that's all I've got for you guys. I think I've given you more than enough, and that's all I've got for you, Celeste, for today.
Yeah, you've given us a lot to chew on, a lot to digest, per usual. A lot of great content. And just to remind everybody too that you can go to the website atptraders.com. Hey, Roger, while you still have that screen, can you go back to your energy? Some people were asking what your energy support, XLE, what your support level was there.
Yeah,
but anyway, you can go to atptraders.com and you can get the recordings. Usually they get posted by about the afternoon and catch all that. So there it is.
I don't know when we're going to exit the trade. We're up about 40%, something like that on it right now. We may exit it sooner, but it's an option. But I think we're going to come down to the base. I think we're going to go to the 76-ish level. Yeah, I don't, and again, I don't think don't get me wrong. I don't think we're like entering a bear market. I'm just looking for a technical correction that could last maybe a week or two. That's all.
Yeah. And it's Kevin's point out a couple of weeks ago, Garrett was on here. He was pointing out some things in OXY that were Occidental that were looking exactly like that. So good catch on that, Kevin. I put that in the chat as well. So go back and listen to that recording too. It's fantastic. So, all right, well, let's keep it going. Let's keep going with commodities. We talked a little bit about gas and oil there. Let's talk about gold. Let's get back to that conversation. Let's get back to the conversation about the opportunity in the gold companies versus the gold itself, buying like GLD or something like that. So Ryan, I want you to take over, fill us in as much as you can about what things that are going on in your company at Caliber Mining, things that are going on in other companies. What kind of fundamentals can we be looking for to get a good company?
Yeah, sure. I don't know if you want me to share my screen or,
Please do, go for it.
right. Okay, so I'm gonna just,
I stopped my share, so please feel free.
perfect. See if this works. Let me know.
Yep.
Everybody see that okay?
Yeah.
First, I think I think it's really worthwhile pointing this out. Should be considering gold and gold equities. And, you know, as Roger pointed out, I talk a lot about gold and our own company, but you gotta be careful not to believe your own BS too much. So just be cognizant of that. And I will be making some forward-looking statements, rest assured. So do read some of the disclaimers I have in our presentation. But, you know, if we look at gold and then gold equities here just for a minute. So, you know, what was it, 2011, 2012 that we saw all-time gold price last time. And you can see how the equities are tracking there. Here, we're looking at, this is a Huey versus in gold. And you can see there's such a disconnect right now on gold equities versus the gold price. And as I say, you know, you look back at the macro landscape right now, just at gold, and you can firmly, I believe, see a path to a much higher gold price for all of the reasons we've discussed. Inflation, you know, interest rates are very high. I think we're going to see some more issues come out of regional banks and banks in the US. I think we're going to see some real currency situations start to play into effect here. We've seen, I think it's almost a 15% decrease in the value. Again, your favorite word, the Dixie, the DXY, since the beginning of the year. It's really starting to come down. Gold is holding. It hasn't really started to break out yet. And the miners aren't even being considered as an investment in the investment portfolio right now. That's why I think this is kind of set up for a really interesting opportunity. Now, we have to be very cautious, as we all know, about what investments to look at in the gold space. Of course, we've got things like the GDX or the NUG, all of these types of ETFs, which play the gold price, right? So if you believe, oh, you know, let's put on a trade for I think the gold price is going to go higher. It's a relatively safer bet, right? Because you get a basket of all these different companies. Okay, what we'll talk about today is caliber, but when you do look at, okay, let's say we have a nice run in gold, and then you know peel it back and go, okay, well, I've captured that beta. Let's look at some of the stocks that I should be reviewing to maybe catch some higher beta as well in a positive gold price environment, which I don't think we're there yet, but we're still at 1950 gold. Like we're, you know, probably $150 away from all-time highs, with what I believe is some pretty interesting setup happening globally right now with all of the central bank buying, the continuous central bank buying. And then particularly for me, what I thought was really interesting was the BRICS countries, many additional countries wanting to join the BRICS and then having a currency that is backed by gold. So you're seeing de-dollarization and a lot of increased interest into gold by these central banks around the planet. So that's you know, first and foremost, setting up the macro picture. It's gold, and then I think it's the gold equities. And you can see here, like based on the Huey, look at the percentage of return just to get back to those highs, which were I think around $2,000 an ounce, let's call it, back in 2011, just to get back to there. And that's basically where we're trading at in the commodity price right now. So there's a huge re-rate opportunity in some of these gold equities. And that's why I think, you know, markets are not even paying attention to this right now. Not at all, right? So I think that's an opportunity to really review. We can talk a little bit about, you know, what I think people should be looking at when they look at individual stocks. So when you're looking at individual stocks in the sector, I mean, it's like any business. When you analyze any business, you want to look at the people. Obviously, you want to look at margins. And then for a company like Caliber, which is a gold producer, a growing gold producer, you want to look at, for additional beta, is how much money is this company investing back into, call it their R&D or exploration? Because what's really critical here, and why would I suggest investing in stocks versus just an ETF that tracks with the gold price, basically, is that when a company is profitable, has good assets, and is growing production, what you really want to look at is what else are they doing that could unlock a lot of value, right? And in our space, very similar to biotech companies, right? In our space, it's if a company is investing in exploration, trying to find more gold, trying to find more metals in which they're mining, and they do in fact find more, and in some cases it can be very significant. You find something that has a lot higher grade, which could positively impact margins and production, right? But then you find another deposit that could extend mine life, increase revenue, and all of those things. This is what I believe we bring as a company. And a lot of smart businesses in this regard are investing in a lot of exploration, because it can really increase the torque or the beta for the stock. Of course, it comes with risk, as Tom and others pointed out. It comes with risks. We can't undermine that. But company like ours today, just give you an example, and you touched on this, Celeste, earlier. New Market Gold was a company we started in 2016, right? And what our group, and this is the same group that is running Calibre Mining, the same founders of Calibre Mining, including myself, is what we look for is we look for opportunities to optimize assets that are producing. Small, that we could see could grow large through operating cash flow and not continuously going back to the market to raise cash or take on significant debt, right? So New Market, we saw an opportunity where we came in, we took over 3 underperforming assets at about $100 million valuation. We raised $50 million, and then through operating cash flow, we were able to again reinvest back into that exploration and optimization of the assets. We were successful in discovering one of the highest grade gold mines in the world, in Australia. So, you know, we could continuously mined that and done more exploration, but we thought, let's create a bigger, better liquid product and merge the company with another gold producer. You have to be really thinking about the financial product, which is our stock, and driving share price performance. That's what we're always looking for, is driving that share price performance to create a more robust, diversified product. So we merged that company with, as you said, Kirkland Lake Gold to create a 500,000 ounce a year gold producer. When we closed that deal, we had a $1.2 or $1.3 billion market capitalization, but we were producing 500,000 ounces a year. We probably had about a $500 or $600 per ounce margin, and we only had a $1.2 billion market cap. Well, on the back of that deal, the value of the company went up 10x over the course of a year and a half. So it ended up being a very good transaction for all shareholders throughout that whole process. That company has now gone on and been sold to one of the largest gold producers out there, Agnico Eagle. So it is a space where there's a lot of M&A that happens for good quality assets and good teams. Right, so I don't know if I want to pause there for a second and see if you want to jump in with any questions, or maybe I just keep going with the Calibre story. You let me know.
I think keep going with that. I've got a couple questions here, unless you, Roger, you want to ask a question or something, jump in there, but keep going. And
I'm good.
Yeah. So now let's, I mean, we're trying to replicate what we've done, right? We look at optimizing assets, taking things, looking at them from a different perspective, reinvesting. So this comes to Calibre Mining, where, we're operating in Central America and we're operating in Nevada. So we acquired the Central American assets in 2019. I raised, and the team raised $100 million to go out and purchase these assets from another senior gold producer, right? So we did that, but we actually did it in a win-win way, such that we paid some cash and we paid them in shares so that they could participate in the upside as well if we're successful, right? So in a short period of time, when we acquired these assets, there's 2 producing mills and then a number of surrounding satellite opportunities that could feed into those mills. And over the last number of years, we've permitted 5 or 6 different operations. We've actually increased production. And I'll just flip to this slide in the top right-hand corner. Since 2020, we've increased production on average of 10 to 20% a year over year, organically through higher grade material, bringing on new deposits. But the key here is that we haven't built any new mills or processing plants, which are the huge CapEx issues and huge CapEx uncertainties. So we've just brought on new underground and open pit mines to feed into the existing infrastructure that was already there in place when we acquired these assets, right? So this is the unlocking of value, or looking at things from a different perspective when you look at individual businesses, not just looking at the bigger picture. So we have the bigger picture, but then we're optimizing these assets to generate cash flow and then free cash flow, and then hopefully make a major discovery that could really drive even bigger value for our stakeholders and shareholders. So I put a bunch of stuff on the screen here, and I think the key is the people. They've done it before, created a lot of wealth for shareholders. We continuously own and buy more of our stock. We have made some pretty exciting new discoveries, but I'll tell you, in the last couple of years, I talk about a high-grade discovery here. We're drilling there now. We actually have 9 drill rigs. It's an impressive number because it's a kind of an indicator of how excited we are about the opportunity. We have 9 rigs on this potential property to see how big could it be and how high grade could it be and what could that lead to in terms of future cash flow. So some of these numbers, and just for the audience here, is that underground on average, you want to see between 3 to plus grams per ton gold. Here we're drilling stuff that's 30 to 60 grams per ton gold. So that's going to give you a proxy of margin. So we're going to be mining a minimal amount of rock and getting a lot of gold out of that. So our revenue should start to really increase. Our margins should start to increase significantly when we start to mine some of this type of material. So that's exciting, right? And we have multiple kilometers of strike length on this thing that could be, very, very much a game changer for the business. We'll see. It's early days and we're drilling it. But at the same time, just to caution the investors, is that, these types of veins pinch and swell. It might pinch out and disappear. We don't know. We're still trying to uncover that. But the good thing is that the company is in really good shape. We've got almost 80 million US in cash, less than $20 million of debt. We're doing 250 to 275,000 ounces of annual production. And we've grown that, as I mentioned, year over year since we acquired these assets in 2019 from about a 50, 70,000 ounce basis where we thought we would be. So we've really grown this business and been focused on reinvesting back into the business. Now, the goal, again, is to merge Calibre or do something with Calibre to create a bigger, more robust financial product, diversified product, looking at ways to grow production inorganically through mergers and acquisitions. And that's the whole name of the game in our space, is to build up a product, work with a team, looking at doing something bigger and better for all stakeholders and shareholders to create a better product. And then you tie that with what I believe is a positive macro environment for gold. You could see some great share price appreciation opportunities.
Good. There's a couple of questions that have populated now, Ryan, if I can ask you a few of those.
Yeah.
And some of these, you may have touched on it already a little bit. Is that okay if I ask you a couple questions?
Yeah, fire away.
Yeah. So talking about, just the cost of the exploration of gold, is there a point where this could actually exceed its return? How are you evaluating that?
Great question. No, I absolutely a critical question because, the fortunate thing for us in our situation is that we self-fund all of this, right? So we have very strong, robust operating cash flows. I'll give you an example. Q2, for example. Q2, our financial results are coming out in a couple of weeks, but give or take, we spent tens of millions of dollars in mine development and exploration in the quarter, but we still added $20 million of free cash to our balance sheet after all expenses. So we're very methodical about the cash flow and reinvestment back into the product, right? But if we see opportunities geologically that we think, oh, wow, this could be a real game changer for us, and we have the infrastructure in place, right? I think this is a real key, is we have the infrastructure in place such that we don't have to build hundreds of millions of dollars of infrastructure. So, 10, 20, $30 million spent on exploration is a drop in the bucket when you compare to juniors or small cap, micro cap companies that have to go out and raise $1, $2, $10 million and dilute their shareholders. This is an opportunity where you don't have to do that. We self-fund all of that, but you have to be scientifically intelligent about, not just blowing money on nothing. We want to make sure we have some return on investment. And, finding gold is tough. It's not like the US printing press where you can just print some more of that US currency, right? So no, it's a balancing act, but we've got a lot of good geologists in the business. We rely on a lot of external consultants as well. But the fact that Yeah, go ahead.
Speaking of that, if I can ask this question too, just about finding qualified engineers or people to do the work for you. How has that been for you? I mean, I know it's been a mixed bag, had some layoffs, but I know a lot of industries have had a hard time getting qualified people. What is your experience, as Dave is asking as well?
Fortunately, we've got a good core group of people that have created a lot of wealth. So people tend to attract to that type of a group. Like we've got a CEO, for example, who worked for, I think now is probably one of, if not the largest gold mining company in the world, Newmont. He was 30 years at Newmont, and his role there as an engineer, he's Australian, but we won't hold that against him. But his role was to travel around the planet and optimize their assets. So he's worked in Peru, in Indonesia, in Nevada, all over the planet optimizing assets. And that's really what he's done here. This attracts high quality people to the business and to our team because of that track record. And so we do have a good group of people that work with us. We also have attracted a very high quality exploration geologist, seasoned professional in Nevada. We've got a 40, 50,000 ounce a year asset in Nevada that I think has real good potential to grow. And if you don't know, this group called the Fraser Institute quantifies Nevada as the #1 jurisdiction on the planet to find and mine gold. However, that being said, the one caveat there is, to your point, is that due to inflation and labor costs, there is a shortage of really good quality people. And if you do go for the really good quality people, you're paying. It's an expensive environment there, and human capital is one of the highest costs there in Nevada. Although one thing we are seeing is, permitting and bureaucracy is getting in the way quite significantly, extending timelines almost monthly, or bi-monthly. We're seeing things getting pushed out quite often. Fortunately for us, we're in production, so for the developers out there, it's very tough.
Yeah, good. What percentage are you in your long-term business model to reach your goal? As Adam is asking, where are you in your goals, your long-term business?
In our goals, yeah.
Mm-hmm.
I think it's still very, very early days. I mean, we've optimized the business so we can self-sustain the business, and we've grown production from 130 to 250 to 275,000 ounces annually. One thing I'll point out here is in the bottom right-hand corner on this slide is that we've gone from a very low reserve base. So that's the amount of gold in the ground, right? When we acquired these assets, there was about 250,000 ounces of reserves. And reserves are the highest category that you can count on for confidence and comfort that, it is there, what you believe is there based on the scientific work and engineering work you've done. So we've actually grown that about 370%, 280% in Central America, and then some in Nevada. But we've grown it significantly, but we're still only at about 1.1 million ounces of gold. So when you look at the life of mine based on the reserves, it's 4 to 5 years. Then we've got a larger envelope of resources outside of that. But I think for us, we really like to see a 1.5 to 2.5 reserve life in front of us. It takes off the pressure. But then, in terms of the bigger picture, we're looking at building inorganically as well. So we're looking at opportunities that could potentially double or triple production profiles, as we've done in the past with Newmarket, Kirkland, which went on to do very well for all of our stakeholders.
Excellent, excellent. Obviously, you have a lot of knowledge in the space. It's fantastic. Thanks for sharing it all with us.
Sure, absolutely, happy to.
Yeah. Do you have anything else that you want, think that we need to know that about the whole industry, about the companies, about Calibre Mining? What do you think?
No, I mean, I think we've talked a lot about gold. We've talked a lot about, the fact that the equities are undervalued. I've pointed one out here, Calibre, which of course I'm involved with and believe that it has great potential and great future, again, based on the track record of the group. But I think that, really you gotta, taking a step back again, I think, look at gold as a currency. It's got no political ties. It really doesn't have a printing press. It rivals the USD, it rivals the euro, and now we're seeing BRIC nations that I believe will get bigger, wanting to put a currency in place that is backed by this stable, safe haven asset. And I think that's really critical, and I think it could really transform the landscape for gold and then of course the underlying gold equities.
Excellent. Well, Ryan, thank you for coming on. Thank you for such a time as this, sharing that information. I think it's very, very timely. I think there's a lot of information. Our viewers can go back and glean a lot of information. And you can just go to the website too of Ryan's there and get a lot of your questions asked or questions answered. Yes, can the cover question and
One thing I'll just say is, Celeste, is that I come across some pretty compelling research on why gold equities. I mean, happy to share things with any of the audience if they're interested in taking a look at third-party perspectives as well.
Yeah. Cyrus asked an interesting question. Who controls the price of gold?
Supply and demand, Cyrus.
Well, there are a lot of things that go into gold though, right? I mean, it's kind of like, the dollar or something, well, how would you answer that question, Ryan? That is an interesting. It seems obvious, but is it obvious?
So many variables.
Let's hear what Roger has to say, and then
supply. I already answered him. Supply and demand.
yeah.
Nice and easy.
I don't think so.
Yeah, I mean, it's really interesting because there's so many derivative products that are traded on gold, shorts, longs, you name it. Most of the trading on gold is paper trading, and so if you ever ask for deliverable on some of that stuff, people couldn't deliver those contracts. And so, now there's ETFs that are not based on paper so much as physical delivery of that metal, which I think people want to see. So there's a lot of smoke and mirrors and a lot of uncertainty behind the scenes of what actually happens to these prices. Supply and demand is for sure one, and I think we're seeing less new discoveries or mines being found and bigger demand wanted by these central banks particularly.
Yeah, good point.
Hey, I got a question, Celeste. Ryan, if somebody wanted to buy coins, either gold coins or silver coins, how would you tell them to do it, and where would you tell them to get it?
What's that?
You might.
Send them away.
We got some Caliber gold coins right here.
Oh wow! Okay.
How do we get those?
Yeah. No, I'm not sure how we get them. Maybe we'll have to look at selling them. But yeah, we actually got the first gold coins ever made by the company, 1 ounce, half ounce. But to your point, your question there, Tom, I think you've got to go to various mints, and there's different ones online. I'm not too familiar with it because I don't dabble too much in the coin space. But there's, you can Google and look at a bunch of different suppliers. But most of the time when you buy that physical coin, it's a much higher price than the spot price of gold.
Right.
Too.
Yeah, there's a premium on them.
Yep, sure is.
The reason I asked that question, I bought a bunch of silver coins back when silver was about $5 to $6, and I had it shipped to me, and I forgot the company I bought it from, but I got a bunch of these coins, and I was just sitting there thinking to myself that this might be time to consider doing that again.
Well, I tell you, it's often hard to get the coins as well. A lot of times you'll go either physically or online, and it'll be a major wait to be able to get those coins at those prices too.
Yeah.
Because of supply and demand. To Roger's point, I mean, a lot of times gold producers like ourselves are just selling to large refiners. Those large refiners then sell their gold to various different buyers, and a lot of times, as I was pointing out, the buyers are different central banks.
Hey, Hartley, I would recommend get the coins as opposed to bullion. I've done it both ways. It gets very difficult for a lot of reasons doing bullion, so I'd go with coins. Hey, if you're right on the direction, you're gonna get paid.
There you go. Indeed.
Excellent. Great. Well, another great event here at Ask the Pros. Thanks everybody for coming. Roger, Tom, Ryan, we appreciate it so much. Appreciate all of you spending your time with us today. And here we are in the middle of July. We'll come back next week for another week in July. Can't wait to share some more information with you. So thanks everyone. Have a great weekend. Thanks, Ryan, again.
Thanks everyone. Bye, Ryan. It was a pleasure meeting you, Ryan. Take care.
Yeah,
bye everyone. Bye, Celeste. Bye, T-Buzz.
Great job. See ya.
Oh, everyone, if you are wanting those slides from Guy, Marie, I see yours.